My name is Stacy Warden, and I run the Center for Financial Markets at the Milken Institute. One of the great things about doing a session in this room on Wednesday is that everybody in the room is interested in this topic and knowledgeable on this topic. And I see faces, I see a couple of faces that I know represent money, represent forward thinking, represent U.S. government in this area. So I will definitely leave, even though I have 5 panelists, I will definitely leave time at the end of the session for questions. So I do want to make it kind of a room type dialogue. And even in the middle, you can kind of feel free to just raise your hand. So no infrastructure topic or panel could ever be started without the moderator talking about the trillions and trillions of dollars of need for infrastructure finance, not just in developing countries, but in the US and Germany as well. And the statistics really, the numbers really are staggering. In Africa, for example, the estimate is that it adds an additional 20 to 40% on costs of good traded across the continent. And in Asia, there's a $180 billion shortfall in needed infrastructure investment. The OECD has estimated that in OECD countries, the shortfall to GDP is 3.5%. And wouldn't that be great if we could figure out a way to get 3.5% more growth out of OECD economies? And in Africa and developing countries, it's even higher. It's 5% growth shortfall given the dearth of infrastructure. So lucky for you, I have the world's greatest panel to talk about infrastructure as an asset class here on Wednesday. To my immediate right is Brian Chase, who is principal and head of North American origination for Campbell Lutyens. To his right is Andrew Claerhout, who's a senior vice president at Ontario Teachers, and he runs the infrastructure fund for Ontario Teachers. To my left is Chinelo Anohu-Amuzu, who's the Director General of the Nigerian National Pension Commission and kind of a rock star on the continent. And I don't want to put any pressure on the other panelists, but she was voted the most interesting panelist at last year's Global Conference. So just saying. To her left is Glenn Ireland, who's a founding partner of InfraShare Partners and many years at Latham & Watkins running the natural resources group, mining group for Latham & Watkins. And then to his left is Katao Kiuna, who is probably known to many of you and is CEO of TransCentury. So I sit on the Business 20, the B20 process that is part of the G20 process for infrastructure finance globally. And we had a big, for the IMF World Bank spring meetings, we had a big B20 meeting. And so we have sort of McKinsey in the background trying to write up our recommendations for the G20. And one of the solidifying recommendations that we had is to establish infrastructure as an asset class. And there was quite a bit of discussion in that room about how infrastructure couldn't possibly be an asset class. I mean, this is more kind of African developing country focus because projects are simply too bespoke. There's just no way to kind of get the economies of that. And Andrew, when I brought this up on the pre-call, you sort of violently disagreed with that notion. So can you kind of respond to that, and then in the context of doing so, tell us about how your firm thinks about infrastructure and how you make investment decisions around it.
Sure, Stacy. And I think that question, that assertion that it's not an asset class would be correct if this was 15 years ago, when very few people were investing in infrastructure and it wasn't very well understood. I think if you look at the asset class now, it is very much a legitimate asset class. And let me explain why. Let me first maybe tell you that I'm new to the infrastructure space. I spent 15 years doing private equity, and only about 18 months ago was I asked by Ontario Teachers to come across and run the infrastructure department. And one of the things I did early on around that was try to say, well, what is this market? Who are the participants? How are people being successful? And we did that obviously to try to understand what pockets of the market Ontario Teachers could focus on. But during that phase of work, we took a look at what the infrastructure market looked like 15 years ago and what it looks like today. And 15 years ago, there was no more than about 15 institutions doing infrastructure in any serious way. And they were mostly Australian and some Canadians, but there were 15. If you fast forward to when we did this work last year, we identified 250 globally that were doing infrastructure in a meaningful way and that we would consider in some way, shape, or form a competitor. And so, I guess first of all, just in using numbers to make this argument, when you have 250 people that have capital, that are chasing infrastructure opportunities globally, it does suggest that there's a number of people out there that think it's an asset class. I also naively believed when I first came into infrastructure that it was either a bond on steroids or it was private equity on Valium. But it wasn't anything between those. It was either a variant of fixed income or a variant of private equities. And I think I've come to understand that that's not the case. If you look at infrastructure, it does behave quite differently than a bond, and it behaves quite differently than private equity. That's because of the fact that infrastructure is something that provides essential services to a local population. It tends to have a high fixed asset base and very high margins as a consequence of that. And it delivers long-term and stable returns. But importantly, most frequently, it has an indexation to inflation. So it also helps protect against inflation. And so when we think about it in our asset mix as a plan that needs to ensure that we're investing such that we can keep our pension promise to the teachers of Ontario, this is a critical ingredient in infrastructure that behaves differently than fixed income on steroids and differently than private equity on Valium. It provides consistent, steady returns which are diversified from fixed income and equities, and which provide either implicit or explicit inflation protection. So I think that is an important point to make. In terms of how Ontario Teachers thinks about infrastructure, we would like more of it. At slide number 1, I don't know if we can flip to a slide, but in slide number 1, it's a very helpful slide that shows allocation to infrastructure as an asset class across institutional investors. And what you'll notice here is that number 1, the allocation is growing. Number 2, there continues to be this persistent gap between how much infrastructure institutions have invested in and how much they desire to invest in. Sadly, we're one of the contributors to that, because despite the fact that we have $13 billion in infrastructure invested today, we'd like that to be closer to 18. So the first point that I would like to make is when you look at the asset mix that we desire as a pension plan, we want more infrastructure. But we're not going to let that motivate us to do things which we deem to be uneconomic. And we'll get into this later in the panel. I don't want to talk for too long, but I think that there is some behavior in the marketplace at the moment, particularly around core infrastructure in OECD countries, which you can kind of scratch your head and say, did that make sense from a return on equity standpoint? Or is that done at a valuation that is very difficult to justify in the longer term?
Okay, Brian, you raise a lot of money for infrastructure companies, and it was very gratifying to Glenn to know that you have agreed already to raise money for his fund that he's setting up. So, in the pre-call, that was. But how do you think about infrastructure as an asset class? How do your clients think about it? Do you agree with Andrew, or do you agree with the folks from the B20 process?
I agree with Andrew in the sense that infrastructure as an asset class is definitely better understood outside of the U.S. In countries like Canada, Australia, and Europe. The one exception I'd say is energy in the U.S. in some ways is better understood among U.S. investors than even non-U.S. investors, and that's because of the way the U.S. finances infrastructure is different than anywhere else in the world. It's primarily infrastructure is delivered through the $3.7 trillion municipal bond market, and so that has skewed what the opportunities are for infrastructure investors within the U.S. much towards more towards water, wastewater, power, energy infrastructure, high voltage transmission, things like that, where there's true private investment opportunity. That the U.S. is funny in some areas we're selectively socialist in how we finance infrastructure. Basically, water, wastewater, most forms of transportation are done through the municipal bond market. That's called public finance, even though ironically the investors that are buying those bonds are wealthy individuals and mutual funds. And what's called private finance in infrastructure is being done by the public pension plans, which don't buy municipal bonds because they don't need the tax-exempt income that's associated with those. So we have kind of the nomenclature backwards in the U.S., but I think the muni bond market has expanded as big as it can possibly be, and so now there are interesting opportunities for U.S. investors. The second thing that U.S. infrastructure investors have realized that most of them want existing assets. They want to invest in existing assets in OECD countries because they assume those projects have less political, regulatory risk, and they don't like construction of new projects because they think of the Boston Big Dig or the eastern span of the Bay Bridge. They're frightened by construction cost overruns and project delays. But I think what they've realized over the last 5 years is that it's not as simple as saying brownfield OECD infrastructure is the way to go. That in fact there might be less political risk for a highway project in Nigeria than a gas distribution pipeline in Norway or a toll road in Virginia. So that's kind of the new landscape that investors are having to understand, that construction isn't always riskier than existing assets, and OECD countries are not always less risky than emerging markets. So it's a more complicated investment landscape.
Right. And that's been a theme actually over the course of the 3 days of this conference, is the misperception of risk in Africa generally. But Gatell, would you say that it's an asset class in Africa, infrastructure, or how do you think about it? Is it different, or how do you think about it at TransCentury?
Just building on, I think, what's been said, it doesn't surprise me that the Australians and the Canadians were first into infrastructure. And the reason is that if you look at the mining industry and the telco industry, especially in Africa, it's really been, in many ways, an infrastructure play. And I'll give you a couple examples. So we were involved in a big mining project in DRC. It's the Kibali gold mine. And in that mine, our role was actually to build 500 kilometers of roads. Okay, so the investors in that gold mine, which today is the second biggest, or probably actually now the biggest gold mine in Africa, actually had to go and build 500 kilometers of road to make that project a reality, right? And it's the very first thing they did, because without building the road, they would absolutely have never been able to execute a project like that, right? So, once those investors really begin to understand just how critical that infrastructure part is, it doesn't surprise me that they're really the first to the market to really, pull it out as an asset class. Maybe the second example is, I think when you look at international investors, the last 20 years, a lot of people have made a lot of money in telecoms, right? Telecoms ended up being a lot bigger than anybody could ever have imagined. And if you look at the players who've really won in the telecom space, and I'll take Kenya as an example because it's a market I know best, Safaricom in the initial days was the second biggest telco operator, and actually was number 2 by quite a long shot. It was quite a bit smaller than what in those days was Kcell, which is now the number 2 player, right? How they initially caught up was the fact that at the beginning, because the number 1 player was owned initially by Vivendi, and the French initially didn't commit the capital required to lay down the infrastructure as quickly, and Vodafone came at it quite hard in terms of actually building out the infrastructure, they really were able to do the infrastructure play much better in terms of building out the cell phone towers and all the rest of it, which made them very quickly the leading player. And you remember in those days, the tagline for Safaricom was, I think, everywhere you go, right? Because they were able to actually get over the country and all the rest of it, right? If you look at it today, the infrastructure bit of it is not so strategic anymore. They're sort of unbundling it to other players, tower operators, and now the game has moved to more innovation and technology, so M-Pesa and things like that. But don't forget, the very early days, if you actually were to go back to, say, the 90s to the sort of mid-2000s, the game was really about infrastructure, and that's what kind of really drove it. And so the last thing, I want to add is that, in our opinion, if you didn't make money in telecoms in Africa, then the money in the next phase is really going to be made in infrastructure, in our opinion. And it's infrastructure, a very broad thing, but in our opinion, the money is in power infrastructure and transport infrastructure, right? These are the two areas where certainly there's really a lot of value on the table, right? So if you look today at all those charts you've seen as the growth of all of the African economies, Ethiopia, DRC, Tanzania, etc., right? You cannot maintain a growth rate of 7, 8, 9% without power. It's absolutely impossible, right? So if you look at what's going to happen in the power space, I always tell people that what you saw happen in the telecom sector is going to happen in the power sector, right? The same very steep trajectory. We're at the inflection point. The reason it hasn't happened as quickly in power is because the disruptive technology of the mobile phone, hasn't been there. We may get to that, but it hasn't been there, so it's taken a bit longer. But I'll just give you one example just to show you. In Kenya, we got independence in 1964. Between 1964 and 2014, so that's a period of almost 50 years, we only managed to connect about 1.5 million households to power, okay? Last year, in 1 year alone, we connected 500,000 households to power, right? So it was an addition of 25% of the total in just 1 year, right? So it just shows you that we did in 1 year what we had struggled to do in 50 years. It just gives you a sense of, and even in Kenya today, you only have about 25% of people who sort of, have access. So that just shows you, what's happening in that space. I think we heard earlier on, the project that Black Rhino are doing in terms of a pipeline for fuel in Ethiopia. I mean, that's got to be a fantastic idea, right? So a population like Ethiopia, as big as it is, and you're trucking fuel from, Djibouti into Addis, I mean, it's absolute madness, right? So just the inefficiency of it, is so high. And if you were just to look at the gap between supply and demand and all the distortions that creates, it just tells you they're putting, an infrastructure asset, to capture some of these, huge inefficiency and mismatches between supply and demand in these economies has just got to be, a very, very good return on investment. So, from a Trans-Century perspective, our focus is infrastructure as a pure play asset class, and it's really, in our opinion, a focus on power and transportation. Not to say there are not other asset classes, but those are the two, in our opinion, that are most ripe for private investors.
Okay, when I come back to you, I'm going to ask you how you think about it and some of the conditions that you've talked to me through some of the important conditions. But I think we've heard a very kind of rosy picture, I would say, of opportunity in terms of infrastructure, but still we're not getting the financing to infrastructure either in OECD countries or in developing countries. So something is stuck. And Glenn, you've got an idea or a notion of how to unstuck some infrastructure finance in a very important sector, which is natural resource extraction and related activities. So can you just kind of talk about your vision and lay out how you think it's a good opportunity for investors like CalSTRS?
Sure. Well, just in terms of how I look at infrastructure, I think as an asset class, one of the challenges of that category, that term, is it incorporates a very wide range of business models. Perhaps the easiest way to look at it is social infrastructure and what I would call industrial infrastructure. Social infrastructure has a lot of challenges such as demand risk and a lot of political risks that come with those types of assets. In developed countries, we developed the PPP model where, in effect, government takes on or assumes certain risks that the private sector, really can't cope with. Will there be enough prisoners for the prison or enough students for the school? And that model works pretty well, but in developing countries, the government isn't there with the balance sheet to be able to provide that support, so the World Bank and development financial institutions come in. In the industrial infrastructure category, I think there's a lot more potential. If you've got a mining client or an oil and gas company or other industrial investment that requires a road, a pipeline, a railway, a port, there's a solid long-term customer, hopefully creditworthy, that can underpin a very financeable structure and transaction on the infrastructure side. Historically, in my experience, certainly on the mining side, the industrial sponsors have actually sought to own and control the infrastructure, but I think we're moving away from that model. I think governments are insisting that industrial infrastructure actually be used to help diversify the economy, to make sure that they don't end up with stranded resources and so forth. In other words, they're insisting that infrastructure be shared. As soon as you tell a mining company, an oil and gas company, or other industrial sponsor, investor, that they have to share the infrastructure, they're a lot less interested in footing the bill for it. That then, I think, creates an opportunity for the institutional investor community to come in and actually say, we will break that infrastructure asset away from the resource project. We will structure it appropriately so it's kind of on a utility model with a long-term stable customer. We'll establish it on an open access basis so we can have multiple customers, we can have some upside in terms of the equity investment, and we can actually mitigate things like political risk on the basis that this very important and strategic asset is going to be welded into the local economy in a way that's very pro-growth, pro-development, and positive for the host.
And how's it going?
Well, it's very interesting. In the resources sector, old habits die hard, and certainly mining companies have made a lot of money and gained a lot of strategic advantage, especially the larger ones, from owning strategic infrastructure assets. Those assets essentially are portals to China, to international markets, and if you own that portal, if you're the gatekeeper, so to speak, then you can monopolize regional geology, you can gain strategic advantage in a variety of different ways. So it's taking some time, I think, for mining companies and to a lesser extent oil and gas companies to come to a realization that that old game is probably up. And actually their shareholders are not particularly happy with the huge piles of cash that they've been burning over the last 10 years, really getting into businesses like rail and port that aren't necessary for their upstream for their core business, the upstream resource projects. So I think they are moving in the right direction, and you are seeing it. For example, BP the other day sold off its huge investment in North Sea pipeline infrastructure, and you see that on the telecom side, where the telecom companies were using their towers business as a strategic weapon to some extent, but coming now to a realization they don't need to have all that capital tied up in towers, and certainly you're seeing investors now emerge that want to be in the towers business. So it's a gradual transition. I think the other thing that needs to happen, frankly, is that the institutional investor community needs to also start to move and be a bit more proactive. And I know that's not the typical business model. I think most institutional investors are just used to kind of being pitched on a daily basis with a variety of different transactions and considering them. They don't have a lot of time to spend on individual opportunities, but some of these situations are a bit gnarly, a bit complicated, and I think if institutional investors want to find these potentially advantageous infrastructure opportunities, especially in developing countries where maybe there's a bit of uptick on the yield, I think they will have to actually be more proactive and engage more directly and at an earlier stage to make sure that these projects and these opportunities emerge as investable transactions rather than slightly half-baked ones, which has been the
And look, we certainly
experience.
subscribe to that view that resource infrastructure should be a much bigger opportunity than it has been historically. I think there is a number of reasons for that. One is we just came through a commodity boom where commodity producers were flush with cash, and we're at the front end of a commodity bust at the moment, where it's unlikely to see mineral and oil and gas prices, at the levels that they were during the boom times. And so, desperate times call for desperate measures. I think mining companies would prefer to own their own infrastructure, but as they look at their own balance sheet and adjust to the new reality of lower commodity prices, I do hope that they come around and say, do we really need to be operating a desal plant or a water treatment plant or a dedicated road or a dedicated port? So I do hope that your advice around this and your predictions around this are correct. I also do think there is this great opportunity in terms of shared infrastructure, because you very seldom have a deposit, either a mineral deposit or an oil and gas deposit, that is in a region with only one company extracting from that deposit. Right? If you look at where coal is, if you look at where copper is, if you look at where oil and gas is, they tend to have a number of different companies in the same region. And so you would think that it doesn't make sense to have multiple ports, multiple roads, multiple water treatment plants. If we can find some way to introduce a third party, to introduce somebody who's not a miner and therefore is not viewed as a competitor into that mix that can own, maintain, and operate those assets, I think it will facilitate the shared use concept, because it would be maybe more difficult for BP to partner with Exxon, because they are competitors day to day. But if you introduce, let's just use a name, Ontario Teachers Pension Plan, into the mix, I think that it may be more open-minded to each of them using that asset with that independent party being the ones that own, maintain, and operate it. So I hope you're right.
Yeah, absolutely.
And I think it is correct, because if what we're seeing on the African continent is that with the commodity prices coming down, people are having to face their inefficiency. So Congo, right? There is no power in Congo today. So people have basically been going to a Greco or people like that and saying, why don't you just put up, I'm in a hurry, 30 megawatt power plant, we're going to truck the diesel 1,500 kilometers from the port, and you produce power at 50 cents per kilowatt hour, right? That's the implication of it, right? But when the commodity prices are high, you can afford to do that. When they're not high anymore, then you have to come back and be rational and say, well, I can build a 10, 20, 30, 40 megawatt hydropower plant here. It's right next door to me. And so what we're seeing is, people coming back to infrastructure companies like ours and saying, well, we'll give you, we've got another life of mine of 15 years, 20 years, so, we'll give you an agreement, but do it for us at 20 cents, right? Whereas 12 cents would be a very good tariff. They're willing to pay you 20 cents because, it's Congo, their actual cost is 50. If they bring it from 50 to 20, it reduces their cash cost significantly. So these are the opportunities that are there for investors.
And I think it's important to make a distinction between the management of the mining company, who does sort of see these as a strategic asset, and the investors in the mining company who would like maybe the management to stick to its knitting and outsource some of these other activities. But when I think about this kind of barbell, maybe it's an asset class in OECD countries, and it's maybe evolving as an asset class, but not quite there yet in developing countries. And I think you got kind of a layup from these guys about the importance of forward-thinking institutional investors, right, and the role that they can play. So, one of the critical components of this is going to be, I think, not local capital markets and local investors. And how do you think about that with your own, mandate of stewardship of pension resources, but the mandate for developing infrastructure on the continent?
Thanks very much, Stacey. I think I have to agree with a number of the panelists. I don't think the issue is whether infrastructure is an asset class. I think we're way beyond that. It is, but I think the issue is, why is it not as sophisticated as it ought to be? Why is it not delivering the results that we want it to deliver? What are the impediments? And that is the issue, not whether it exists. And from what we've been hearing and indeed experiencing in a country like Nigeria, it's always to do with the packaging of the infrastructure as an asset class. Who are the players? Do they understand what they need? And those that do understand what they need, do they have the capacity to bring it to bear? And that is the issue in infrastructure. And it's unfortunate for a continent like Africa, and especially a country like Nigeria, singularly the continent's largest economy, one of the largest populations, and yet we do not have adequate power. And yet we do not have adequate transportation, no roads, no railway. And these are things that are indeed, by the sheer numbers of people in Nigeria, are economically viable. So what's the problem? Those that have the money to invest always fear one big thing: political risk. They are not sure that they'll take their money there and tomorrow you change a government and they do a U-turn and all your investment's gone up. Somebody talked yesterday about a fear of nationalization. They bring in all this, all these assets, and then they go into infrastructure, and one decree, they send them out. And I think that's where an institution like the pension funds comes in.
How would that work?
Because it's a locally grown fund, and we are in Nigeria, understand the risks of that. Take the pension industry, for instance. 11 years ago, it was a sorry story. And it was full of mismanagement. People were not getting paid. They were operating a highly inefficient defined benefit system. And all it took was the political will to say enough. It was the then President Olusegun Obasanjo that started it. Did a reform, introduced two asset classes, two classes of finance managers, started a completely new pension industry, introduced a contributory pension system, and all of a sudden we've gone from a story of woe to one of positivity. We have, well, depending on the exchange rate you use, about $27 billion in of assets under management. And it's a clear example of where the political will is right. And because we've had three governments since then, Obasanjo, the Yaradua, even in his, with his many medical challenges, he was solidly behind the pension reform and gave us all the support we needed. Incoming president, I mean the president as we know him now, President Goodluck, he brought in a total overhaul of what Obasanjo did in terms of expanding the investment of the pension assets to include infrastructure. It wasn't there before because at the first stages it was more of a collation stage. Right now of investment stage we have it. The incoming president, Buhari, has named the solution of power as one of his key whatever, and he's also considering using the pension fund. So he wants to know how this can be done. So I think a big step in trying to mitigate the fear of why I would choose to go to Nigeria, where fortunately the returns are always higher and always outweigh the risk, is political risk. And that way you co-invest with a local investor, a long-term institutional investor like the pension funds, like the local capital markets. I'm working now with the SEC in trying to mitigate the cost of raising an asset class that will take care of all the infrastructure needs. That is the key thing. This co-investor, find a local operator who understands the market better than any foreign investor, who also have established some track record of corporate governance in where they invest and their returns. And
would you be willing to work with the likes of Andrew?
I know I'm not just going to be willing, I'm actively going to seek him out.
Okay.
So that we can do
Fantastic.
so
That's
we can
what
do
we're all
that
about here at the Milken Institute.
No, I mean, it makes a lot of sense, what you're saying. We haven't done a lot in Africa. We've done some investments in emerging markets in South America in particular. But we certainly subscribe to the view that if you're going to invest in a country that's far away from home, with different languages and customs, and you have these lingering worries about governmental changes and other things, you know, invest with a local party. Invest with somebody who not only can connect you with what's going on the ground and have a proper interpretation of that, but where if there was this repatriation risk, which is a fairly extreme but remote risk, right? If there was this repatriation risk, you're aligned with somebody who is local, where the local government that would be doing that to you, changing the regime, repatriating the asset, would be hurting another arm of the government in doing it.
And all the teachers, depending on the pension.
Right. So I mean, this exactly. If we were to come to Nigeria, you know, we'd want to do it with you, not only because of the expertise that you bring on the ground, but and the local flavor that you bring, but also the fact that you know you help us get comfort that if there was an adverse ruling, you know, it's going to be much less likely for that to happen.
Yeah, because
with
they
a
would
local
have been
partner.
on the table at that. Well, before that ruling becomes a policy, becomes a law, the pension commission would have been part of the decision and would have said, no, this will not go well because we have this investment here and you need to be protected.
Andrew, you mentioned Latin America. I think a good example that illustrates what we're talking about here is actually Peru 20 years ago. For various historical reasons, Peru had quite a vibrant local bond market, and whenever we were doing mining projects there was always a big slice for institutional investors from the local Peruvian institutional investors, and that gave foreign capital huge comfort, right? That they were there alongside with the advantage of sovereign wealth funds and other pools of capital locally in Africa. I think you can achieve the same kind of result.
And I want to just assure you both that my matchmaking finder fee is very, very small. And staying on this theme of the importance of local capital markets, Gatel, I was hoping you could tell your anecdote and sort of elaborate a little bit on the fundraising in that was tried for so long with the.
Yeah, that was painful. I think you have to ask yourself that if it's such a good opportunity, why isn't it happening? Because I think if we're honest with each other, you know, infrastructure hasn't happened as quickly and as widely as one would expect, right? And from my experience, the single biggest problem with it is the debt financing part of it, right? You never struggle to get the equity because the equity returns are very high. You know, on average, most people who've been doing power projects in Kenya all walked away with, at the very worst, maybe 18% equity IRRs. The guys who got there in 10 years ago have made 30%, right? So, you know, there's a lot of money to be made, you know, from the equity side. The problem has really been, you know, you can never do infrastructure all equity. So, you know, there has to be a debt component to it. And this really falls into, in my opinion, sort of three buckets. One has basically been infrastructure that has basically been built on balance sheet by companies because they needed it anyway, right? And I think telcos is a very good example of that, right? You know, so they got money that was lent to them on their balance sheet, and basically it was a big infrastructure play, hugely successful. I think we can, you know, all see the impact of that. Then you basically got the project financing space, whereby people were not project financing infrastructure, they were project financing oil and gas, or they were project financing mining, and really, you know, took a bet on a broader industry and, you know, players that they understood, etc., right? So a good example of that is a project that we did in DRC. It's Anglo Gold Ashanti. The project, you know, has international investors funded, you know, overseas, etc. At the end of the day, it's a mine, but there's a huge infrastructure component to it because you can't build a mine in DRC, you know, without building infrastructure, right? Then there's a third component of it, which is basically what I'd call the DFI funding, the Development Finance Institution, which is, and here's where I run the risk of offending, but it's you know, the IFCs, the OPICs, and people like that, right? And let me first of all start out saying that if it wasn't for them, a lot less infrastructure would be built. It's very clear, right? And if it wasn't for them, we wouldn't even have IPPs and these types of regimes, right? But the challenge with it is that it's extremely slow, okay? And I won't get into the boring details of it, but basically on average, it's taking 7 years, you know, to close an infrastructure financing just on the debt side. And I'll give you an example, you know, where, you know, we eventually lost a lot of money, but, you know, we were involved in a railway, which we really thought and still believe was a very good opportunity. The reason is that it was a corridor which was basically feeding about 200 million people in East Africa from the port of Mombasa, which with all of the freight needs required, right? Now, the road infrastructure just wasn't there to support, and just to give you a sense, over 30 years, the port volumes had grown more than 4 times, and the road infrastructure just didn't have the capacity to meet it, right? So it was very important to get the railway, you know, to move, right? You know, the equity, you know, we fought viciously over the equity because everybody understood just how much that was worth. But it took 8 years to close $164 million of debt, okay? And the problem with infrastructure assets is that if it was a greenfield asset, you can afford to do that because you're not really burning a lot of money while you're waiting for that. But this was a brownfield asset. So, you know, every year we waited, we lost $10 million, all right? Because it was the operating loss was $1 million. So over 7 years, you know, we lost $70 million just waiting to close $164 million of debt, right? So this whole time, and so at that point in time, there's nothing like cheap money, right? You know, it could be even LIBOR or LIBOR minus, but if you've already lost that kind of money waiting, it doesn't matter, right? So, you know, the big issue on that third bucket is really how to finance, project finance, pure play infrastructure assets, where people are not looking at the oil and gas or the mining, they're looking at the infrastructure asset. And I know I spoke a lot about it. The local banks have a problem because they have short-term deposits.
But you get a local raise. That's the.
So the way we did it in the end is actually we went to the international capital markets and did a Eurobond, and we basically did it on balance sheet, right? Which and I was joking to someone the other day. I said, look, you know, if the U.S. was going to build power plants project finance by project finance, you know, you guys would also be sitting in the dark like we are, right? You know, because it just it doesn't work, right? So. It's very, in my opinion, you know, this whole funding model has to change, you know, unless we have people who can actually think differently in terms of how to do it, fund on balance sheet, you know, bring in the institution. You know, the whole thing, you know, has to be, you know, rethought from scratch because the way it's been done today is somewhat.
Yeah. Let me stop you there though, and go back to Brian for kind of. So how to Gachow's point, how would you sort of, how do you think about it? What has to be in place? What are sort of the requirements to make the funding model work?
Well, just thinking about political risk as one of the main issues investors worry about, there's different techniques that they use in different places. So we helped raise a private infrastructure fund that, as part of their investment strategy, they invest in toll roads in India. So the way that they mitigate risk there is they partner with the IFC, and the IFC has the ability to offset against any funds that they owe India for any impairments under the toll road regime. So that's one technique. Another is partnering with local strong institutional investors. So a local public pension plan is a great way to also help mitigate risk. And I think that was the lesson that the private investors learned in Norway when this gas distribution system was impaired in a significant way, and there was no local private investors that were there. So I don't think they would have done that had the local Norwegian oil sovereign wealth fund been involved in the investment. In the U.S., it's interesting. There's a lot of political risk here for infrastructure projects. At least in the emerging markets, you're typically dealing with the national government. So, you know, it's a clear path to how you navigate the political risk. Here in the U.S., what a lot of non-U.S. infrastructure investors realize is you're actually dealing with, we have a very localized system for infrastructure ownership and operation. So there's actually over 46,000 government agencies that own and operate infrastructure in the U.S. and then finance infrastructure improvements through the municipal bond market. So each one of those government agencies has its own relationships. It has a strong mayor, it has a weak mayor, city council relationships, district relationships, and then there's a whole network of vested interests that are associated with kind of the status quo of how infrastructure is delivered in the U.S. So those would be the general engineering consultants, the muni bond lawyers, the muni bond underwriters. So there's a big constituency that fights any project, and we saw that play out on the Indiana toll road deal, which is one of the largest transportation infrastructure deals completed in the U.S. recently. A lot of the local government agencies were being egged on by their existing advisors to really, you know, make a big stink about the fact that there was non-U.S. investors from Australia and Spain and Canada that were looking. So I think even one of them mentioned that you know, we'd been at war with the Spanish within the last 100 years, and so that, you know, made them somehow suspect. So it was pretty interesting to see political risk play out in the U.S. versus in some of the emerging markets.
And I think that's a point that you always make that I think is greatly appreciated. Is a little bit, you know, take the white hat off when you're criticizing other countries.
The U.S. is a sleeping giant, right? We've always kind of characterized it as that. It's the world's biggest economy. It's got a ton of existing infrastructure, much of which needs to be rebuilt or more properly maintained. But because of everything that you said in terms of these existing structures of the muni bond market, you know, mayors that maybe use certain assets as a way to put people in powerful positions, et cetera, it's a very hard one to figure out. So we hope that giant wakes up soon, because it would be a great investment opportunity, but I'm not that hopeful, sadly. I think, though, we've been doing a lot of talking about the infrastructure funding gap, you know, in different ways, which is why is it that there's all this capital chasing infrastructure? And again, if we looked at slide number 1, you know, you've got this gap between, you know, where people are allocated and where they'd like to be, and yet there's all these projects that aren't getting funded. And I think we've raised some of the issues, but one of the big issues that exists is doing greenfield infrastructure is hard. It's really hard. A lot of the people like ourselves are set up to be investors, and that's why we gravitate more towards existing brownfield structures and say, I know what Indiana Toll Road looks like. It has a long operating history. I can go visit it, and we can make an estimate on future demand based on a long history of past demand. One of the things I think we have to do better as an industry, and we're certainly trying to find a way to crack the case on this at Ontario Teachers, is find ways to work with government and with development companies and engineering, procurement, and construction companies to do a better job at creating new infrastructure. Because that is where you can really deliver a difference in a lot of people's lives. And it is an area that, you know, with my hand on my heart, I'll tell you, it's an area that large investors, you know, like ourselves, have not done a good job addressing historically.
Can I just make a
bankable projects? Yeah.
Can I make a comment on that? Because I think it's an excellent point. again, from the African context, there is no brownfield assets per se, right? It's all greenfield. You don't have a choice. But so we start from there. But what has been really interesting for us is that when we look at what I'd call the more Western investors, is this whole mindset of, I'm going to get my friend from Latham Watkins, he's going to do a wonderful legal document, and I'm going to contract all the risk away, and I'm going to be fine, right? And then they take a big surprise when things start to go wrong and they lose the money. They say, but I paid Latham Watkins and all the good guys, and this shouldn't be my problem. And unfortunately, it doesn't work like that. And from our experience, what we've really learned is that you cannot contract away these risks, and you can't just use the lawyers to put them away. So our model actually is that we actually own our own EPC, engineering construction company. We develop the projects ourselves, and we actually operate, right? Because we know that at the end of the day, if you're putting this kind of money to work, right, you don't run away from the fact that actually, you have to manage the risk, not contract out the risk, right? So from that perspective, I think it's something that, you really, really, really need to think very carefully about.
And I do agree with that. And we find that a lot of places we're allowing the pension funds go to, you all just look at not just the investment, but also the capacity to deliver on that investment.
Execution.
And you need to be careful that the people who purport to execute it can actually do so. And unless you do that, then you can't look away and say, okay, the numbers look good, and then you walk away. The company that's purporting to provide this, can they? Do they have the adequate structures within the company itself? And in doing this, what we have also found out in Nigeria, especially in the deployment of the pension funds, is that we're growing capacity. Because people are now forced to, in their desire to access the pension funds for whatever ventures they were going to, are obliged to meet a certain benchmark. And this is where the DFIs come in, the IFCs, and they've done this for a while. So what we go to them, it's not so much as come and do this for us, it's the expertise, the capacity transfer, so that these are the things that they've done, they know how to, they risk, but then we take it over and domesticate it and make it work at a faster rate. So it doesn't take 7 years. We don't have 7 years. And make sure that at each point in time, instead of looking at an isolated, delivering various things, we look at the total picture, what we need to get done, and then make sure that we are aware that they can deliver, because risks can never be completely obliterated. That is the truth. But you can manage it to the point that whatever then happens, it doesn't affect the success of the project.
I think we as an industry, need to think more carefully about the structures that we use and recognize the difference between sort of pre-completion risk and post-completion risk, and find ways to make sure that the incentive structures are there for people who assume those early stage risks, and then find ways to sort of transfer that de-risked asset to pension funds who are better able to hold it as a stable, secure asset for the longer term. Okay. If you think about it in the mining context, for example, if a mining company has to spend $20 billion to build an integrated operation, that mining company is going to take overrun and project delay risk for the whole thing. So, in principle, they're prepared to take that risk. If you say, well, let's take the infrastructure piece away, but actually, mining company, could you retain the overrun risk and the delay risks until we get this built? Well, they might be prepared to do that. If you also then tell them that their competitor is going to be able to come along on day 2 and use the asset, where they've made the commitments and underwritten the completion risks, and now their competitor comes along and free rides off of that, of the risks that they've assumed, then they get a bit twitchy. So working out how to make sure the first mover gets the right incentives, and the second one and the third one that come along and use that de-risked asset actually pay the first guy is the tricky bit.
It's the structure.
Yeah, it's the structure.
That's very
and
key.
It's not easy.
And with that, let me give a shout out maybe for the Aussies for a second, because if we think of the OECD markets, I think Australia has gotten this nailed to the most part. I'd say so even more strongly 3 months ago before elections in Victoria and New South Wales, but put that aside for a second, which is who's going to take the risk of developing a new asset, and how do we properly compensate them for that risk? The model that the Australians have done is one of asset recycling, which is they've taken their mature assets and they've sold them at a very opportune time. Because if you look at the prices that they've been able to garner on the sale of assets that they've made in the ports industries as examples, they're absolutely stratospheric prices. And they've made a commitment to their voters that they're going to not take that money and squander it, because there is a lot of suspicion around government's ability to manage money in most countries, including Australia. They made a commitment to say that they will take that money and they will invest it in new infrastructure projects, which they will build, and once they are built, they will sell it. And the reason that they've been able to do that is because a central role of government is to try to use the capital that they have and the ability that they have to tax and other things to create a better environment for their citizens. And the Australian government, I think, has done a very good job of recognizing that what does create a better environment for their citizens, what does encourage greater commerce, what makes Australia stronger is infrastructure, and the government has not been shy in any way to step up and be willing to take a role in developing that infrastructure, with the idea that once it's developed and it's operating, they'll look to recycle it to keep the cycle going.
Right. At the beginning of every panel in the sort of the in the preparation room, always, every time I moderate a panel, I say, don't always make me be in the middle, talk to each other, and this is the first panel where they've actually done that. It's really just been great. But we have so much talent in the room. I do want to make sure that we leave the last 10 minutes for any questions or comments from the audience, and happy to call on Mimi Elamelu or anybody else but please, why don't you?
Just curious, for an investor like Ontario Teachers.
Can you pass on the mic, please, Cameron?
For an investor like Ontario Teachers, what's a typical investment you have on the books right now, and what would you be looking for going forward?
Okay, I just want to collect a couple. So can we grab the question in the back? So typical investment.
I suppose it's really about what the rate of return is that you think you need on existing operating infrastructure, which has got no obvious revenue return. So the social infrastructure and so on. And how did we distinguish, second question, how do we distinguish between the payback on an infrastructure where people do buy fares or they buy the power or whatever, and the infrastructure where there isn't anything like that, like the school or the hospital? Yeah. So that for me is the kind of key question here.
Yep. Any other comments? Okay. So Andrew, why don't you start, and then we'll
to
talk.
start, recognizing that we've been in this business for 15 years and our portfolio reflects investments that have been made over a long period of time. If you looked at our portfolio, it is mostly OECD nations. It's mostly brownfield. It's mostly what I would characterize as core infrastructure. Things that you can't debate if it's infrastructure. It's seaports, it's electricity distribution, it's electricity generation, it's airports, it's these types of things. When we look at that part of the market, we actually think that that is the most overbid part of the market at the moment. Because as we've gone from 15 serious participants in the market to 250, as I explained at the front end of the conversation, the new entrants have gravitated to the lowest risk and also lowest returning assets that kind of check all the boxes in terms of core infrastructure, OECD, brownfield. So what we've been trying to do on a go-forward basis is move up that risk-reward continuum. Look at how we can get involved in what we call infrastructure plus. So things that have a lot of the characteristics of infrastructure but maybe aren't considered core. Looking at new geographies, things that aren't OECD nations. Looking at earlier stage opportunities where we can take a part in helping create infrastructure, whether that be pure greenfield, which is tough, very tough because we need to work hand in glove with an EPC to do that, or whether it be what I refer to as khaki infrastructure, which is where we take a brownfield asset. We take a brownfield asset and we introduce greenfield elements to it such to make this khaki color. So I think if you were to look, just to answer your question, if you were to look at our portfolio, it does reflect 15 years of investing history, and frankly the right thing to be doing 10 years ago was to be investing in core infrastructure in OECD nations. The returns on that were double digit, they were very attractive. We're not convinced they remain very attractive, and so we're pushing ourselves to be more creative, to take on greater risk in exchange for greater return.
Okay.
Yeah, all we do is control or control-oriented equity. That's what we do.
Does anybody have thoughts on this sort of, how do you?
It's actually really interesting because if you look at our portfolio, it's almost like the polar opposite, but we're much less established, but much more sort of young and entrepreneurial frontier market type company. So, our portfolio basically has what I'd call infrastructure services type assets. Because in this industry, it's very important to get to cash flow generation quickly. And so we basically have manufacturing companies for electrical cables, transformers, everything that goes into the electrification. We have an EPC company that builds, etc. So that's basically what I like to say keeps the lights on and generates the cash. Because one of the big risks is just sitting and burning cash for a long period of time.
Okay.
But then when we look at the pure play infrastructure assets, again, it's really all greenfield. But the big difference there is that, we're the developer, we're basically the EPC contractor, and we're the operator. So we basically look at it end to end.
Okay, so I've got the 5-minute warning, and I want to go down the line in a lightning round and ask all of the panelists, we've got a lot of money in the room here. What is your single best infrastructure investment idea for the next couple of years? So, who wants to start?
Ladies first.
Okay, let's do it. Let's have it. The bold go first.
No, I think for the next, especially for a country like Nigeria, and then a continent like Africa, you should face power, transportation, and just two. Every other thing will follow, and the returns are remarkable. Thank you.
Okay, Glenn?
I would say industrial infrastructure projects with long-term creditworthy customers where there is a misperception of the political risk, so there's a mispricing of the asset. Political risks are actually overstated in the market.
I would say distributed power. So, there's got to be the equivalent of the mobile phone in telecoms in power. Today, if we just go back to having a power plant, big transmission, distribution, and trying to replicate what the US has is going to, take too long. But if there is, whoever gets it right with a good distributed power model, especially in Africa today, where there is no existing infrastructure to compete with, so that will be the mobile phone of it. That's just going to be a massive, massive hit.
Okay.
Well, I don't believe in sharing my best ideas.
How about your second best
So maybe
idea?
what I'll do is answer the second question that was asked and we never got a chance to answer, which is what we do with social infrastructure is generally have it made on an availability payment where you're not taking demand risk, where the government guarantees you a return on the asset that you've built, like a hospital or a prison. And so that's typically how that is handled.
I'd say an area that, so some of the most sophisticated investors we cover that are active in infrastructure are endowments and foundations, and they're spending a lot of time trying to understand whether or not there's an investment opportunity for export-focused agricultural logistics in emerging markets. So it's kind of a very niche area, but very interesting, and it seems like there's a lot of possibility if you believe in the longer-term trend of urbanization, growing middle class, greater protein consumption, those kind of things.
Okay, so there you have it. Thank you very much to the panelists. What a